Thank you for downloading this recording. I hope that everybody is fine. Today I'd like to focus, without wasting too much time, on changes in group structure. Now, it is a reality that from time to time, investors may wish to sell or to buy more shares in a company. All right, and from your previous studies, you should be able to remember that if you're dealing between 1% to 19% shareholding, then you're dealing with a financial instrument that is called a mere investment, all right, in a company. All right, if you're dealing with shares between 20% to 49%, you're dealing with an associate, and associates are accounted for according to what we call equity accounting. And if you have got more than 50% of shares, all right, 50% and above, it means that you've got control over your investments. All right. Now, what is important to know is just basic principles under this particular discussion. If we are going, for instance, to increase our shareholding in an investee, in a subsidiary, for instance, from 70% to 90%, we are dealing with what we call a transaction between members. There is no need for us to recalculate goodwill. All right. If you are dealing with a change that involves, let's say, drop from 40% to 20%, you are dealing with a transaction between investors. Now, one of the critical things that you need to know when you're dealing with these changes in group structure is the threshold of 50%. We call it control, because when you get more than 50% shares in an investee, you have got control. Every time we cross over this line, goodwill will be affected. All right. When you, for instance, when you move from 40% to 60%, you have to recognize goodwill in your investment. All right. You're increasing shares in a company. You're an investor increasing shares in a company. From 40% to 60%, goodwill must be recognized. If you're dropping from 60% to 40%, then goodwill must not be retained. I hope that is clear. So for us to make this a little bit more interesting, we go to a question. Again, I'm using London School of Business and Finance material here. At the start, lady acquired 10% interest in Gaga at a cost of 25 million. At the end, lady acquired a further 45%. I hope you're counting now. 10 plus 45 gives us 55. So we would have crossed the control threshold. The 45% interest is acquired at 120 million, and therefore we obtain control. Fair value of the initial 10% interest at this time was 27 million, and the fair value of the NCI was 110 million. Fair value of the identifiable net assets is given 150. Required, you compute goodwill, since now we are acquiring control. All right, let us do some bit of work. One of the things we see is that we are moving from mere investment in the firm to a control status. So mere investment status to what we call a control status. How do we go about doing this work? It is not as difficult as it seems. So please take out a pen, paper, and begin to write what I'm doing. We start. Fair value of cost of investment is the first consideration. We have got two interests. The latest interest is the 45% interest. Let me write that one properly. What is the cost of 45% interest? Of course, it was 120. Next, what is the cost of the 10% interest? How much was the figure? That was the 27. And what's the fair value of NCI? It has been given for a reason, so that we can establish the correct figure for the full value of this particular entity. We have got that figure. Then we less the net assets. All right, net assets of SAB. How much was the figure? 150, of course. All right. How much is your goodwill? Just sum up. I hope you are seeing that 107 is our goodwill. All right. I hope that that is clear. I hope that you can navigate around that. Now, you can take out a pen and write following the gain on the initial equity. Okay, gain on the initial equity of, remember, the initial equity is now valued at 27. We bought that at of 2 million. 2 million. 2 million. All right. Is to be recognized in the profit or loss? Is to be registered. Recognized in the profit or loss. All right. Or indeed other comprehensive income, depending on interpretation. So please let us remember that. Let us remember that. Okay. Let us go to another question and see if we can make sense out of this. We've got adamant required. Discuss or compute rather profit on disposal to be recognized in the income statement. At the start, Adam acquired 70% of Ants for 460 million and had identifiable net assets with a fair value of 300 million at acquisition, and the fair value of the NCI was 200 million. At the end, Adam sells 25% of Ant for 250, meaning that we lose control, but retain influence through its remaining 45% ownership. The fair value of the associate retained is measured at 410. At the end, Ant had identifiable net assets of 330. The growth of 30 million had been reported through the income statement. So again, before we go very far, it's wise for us to compute goodwill, because I think goodwill in this case will have to go. All right, so adamant, that's the question. All right, it's a little bit funny because I don't know how you can have Adam for your aunt, but it is what it is. So let's do the work. Say fair value of cost of investment was 460. Please make reference to the paper, to the book, or to the notes. NCI at that date at acquisition is given 200, and fair value of net assets at acquisition was minus 300. So again, we do the summation. Yes, we've got a 360. All right. Now let us deal with the issue of disposal. We deal with the issue of disposal. All right. Let me just get that one right. This is supposed to be millions of dollars. Even here, it's supposed to be millions of dollars. All right. Let me just get that figure. Get that symbol. The currency, we push it where it belongs. All right. So now we are on the disposal stage, and it's very important for us to pay attention to what is going to be discussed. Okay. So how much did we dispose of our 25% interest? So actual sale. All right. Let's check our working. At the end, Adam sells 25% of Ant for about 250 million. So we push it there. 250 million. No, not the one there. Next, what else do you have? You have got the deemed sale proceeds. Okay, deemed sale proceeds. Let us get on. We're told that the fair value of the associate returned is 410. That will sit on this line. The deemed sale, they assumed, is 410. All right. Next, we are told that NCI is standing at, let's do the calculation. We say 200, that is the starting NCI, plus the profits for the year multiplied by NCI share, which is 30%. How much are you getting? Can you do that? Equals, let me just get 30 profit for the year times 30% plus 200. That's the correct amount there. All right. So please remember, this stands for 25% of the sold stake, and the remaining is 45%. And then we have got NCI, of course, at 30%. All right, so now from these amounts, because now we're able to establish the total value before this particular disposal assessment takes place. So now we say, let us list net assets. All right. Net assets at reporting. Let me just check. There's the question there. At the end, Adamant had identifiable net assets of 330, so we list that. Okay, let me go back. We say minus 330, and then we say goodwill should also be derecognized. Less goodwill. All right. So what do we have? How much is our goodwill? 360. I hope you can see that. There we go. So was there profit or not? Let's these figures from the figure there on top. Yes, there was a profit of 179. That's what we were looking for. So I hope that you have seen how we have proceeded on that one. All right, hope that you have gotten one or two things. I want us to proceed to the next question, which is Iggy Pop. At the year start, Iggy Pop acquired 70% of Pop for 350. Fair value of the identifiable net assets of Pop at the point of acquisition was 110, and then the fair value of NCI was 138. Required compute goodwill. I think this should not be difficult. At the end, Iggy acquires a further 10%, so we are still within the realm of control because we're just moving from 70 to 10%. We're acquiring about 10%, valued at 55 million. Pop had made profits and grown by 20 million over the year. This is a profit after tax, and therefore the current value of the identifiable net assets of Pop is 130 million at the end. Required transfer, make a transfer rather from NCI and effect, show effect on non-controlling interest. Let us find the easy goodwill, and then we can deal with the other one later. So this is Iggy Pop. All right. Again, millions. of dollars. I would like to suggest cost of investment. This is goodwill, of course. Find goodwill. Cost of investment. How much did we see there? We bought the 70% stake at 350. Then NCI at acquisition. How much do we have? I've got 138. And what else do we have? Less net assets minus 110 at the date of acquisition, of course. How much is our goodwill? That is the figure there. That's what we have there. Perfectly done. Now we remember that goodwill will not be affected in this case, so we proceed to see what is happening to our NCI. All right, before NCI before, how do we proceed? You say 138. Remember that you can always do this. NCI before, of course, at the reporting date, you get what we just did a few seconds ago, about 30% of the reported profits, which in this case we're dealing with 20. Okay, let me remove that. All right, when you do the maths, you need to, of course, that's the figure there. All right, what is the change in NCI? How is this? We are told that we acquired a further 10%, so meaning that NCI is going to reduce, of course. So what you do, you say of the 30% we have acquired 10%, if I may write that, has been acquired, and the 30% was just before the acquisition was valued at 144. I hope that you can see that. All right, so how much do we have? Let me just write this one. Is the decimal going to? Please use your calculator. I'm going to just write it straightforward. We've got that figure there. NCI is losing 10%, and so it should reduce by that value there. All right. Let me just write it in brackets for consistency purposes. Wow, that is still showing something. Let me just try to check what is happening here. All right, so let us sum up. That is your NCI after. NCI after the change, after increase in parent shareholding. Now let us also discuss the issue of parent shareholding in terms of whether they have gained reduction in controlling interests. As parent gains, our argument is we transferred, all right, 48, we paid 48 for the additional 10% stake, and then what you see is that, let me just check there, no, we bought a stake that is valued at that much, Yeah, that's what you can say. And the proceeds that we transferred were more than that. So we transferred about a 55 million. It's supposed to be million here. Can we please sum up? We have got that figure, and that is a loss. So you pay cash of 55 for stake that is valued at 48 here. You'll be making a loss of 7 million. Thank you very much for that. If I find similar question, we have got Iggy Pop Parallel Universe. This one I would like to ask that you do it on your own so that you can see how far you've gone, and you can also do Buster Rhymes at your own time. Thank you very much. Next time we meet, we're supposed to do more work on ventures. We discuss joint operations and joint venture, and then we shall go on and do a bigger question, which is Freddy. Thank you very much for listening, and I hope that you will come up with